Hey everybody, it's Kory. Thanks for joining me. Happy New Year. All right, so in this video, we're going to take a real quick look at the year 2023 and how the housing market fared here in North Idaho. And then at the end of that, I'm going to come back and tell you my thoughts on what to expect for 2024. All right, let's get into the stats. Okay, looking at the year-end stats for 2023, the first thing we're going to look at is where did the median sales price end up being? At the end of the year here, the median sales price of a home in North Idaho is $519,000, down 3.7%. If we put that on a historical timeline where you can actually see it on a graph, you can see here that prices have been going up right here since 2012. They've just been going up, up. And they did that until January of this year. And at that point, we were at the peak of $540,000. And then the prices went down until June. And in June, the low point or the trough from the peak went down to $510,000. And we saw the prices come back up on the second half of the year to where they're at now at $519,000. And again, that puts us for year over year at 3.7%. Not a market crash, but it is significant in the sense that we have stopped the price increases. All right, inventory or homes for sale. You can see here that inventory has been going up, and you can see that this year, it ended at the end of December, we had 1,522 homes on the market, and that was up 22.2% over last year. Over the last 3 years, the inventory has basically doubled. In the low point of June 2021, where our inventory was absolutely at its all-time lowest, since then we've doubled the homes staying on the market. And it looks like this on a historical time graph. What's significant about this graph here is you can see that the homes for sale, the inventory, has been traditionally going down. And it went down until right here. And this is a significant point in time for our market because in June of 2021, that's when the median price of a home here went over $500,000. And that just puts a lot of people out of the market when you get at that median price. The average sales price at that time in the market was about, in the United States market, was about $350,000, and we were at $500,000. And a lot of people that were moving out of California or some of the bigger cities that wanted to move here in June of 2021 saw the $500,000 price point and said, forget that, I'm going to Texas for $350,000 or Florida for $375,000. So that's when we started seeing our inventory or the absorption rate of people buying up houses just stop. And then this next point on the graph that is significant, you can see that the inventory started to climb right when the Fed started jacking interest rates in March of 2022. So you can see here we're at June 2020 levels. So again, what is significant about our inventory, even though we've doubled over the last 2 years, you have inventory back to where it was at June of 2020 when nobody was buying houses. And you can see here we're nowhere near the mean, which would be somewhere in here between 2,000 and 3,000 homes at the end of the year for sale. And you can see we're nowhere near what it was during the Great Recession when you had over 4,000 homes on the market. We're simply sitting here at 1,500. Now, inventory usually stacks up because new homes are flooding the market. That is not what is happening right now. Our inventory is increasing because of lack of buyers, not because of inventory flooding the market. And you can see here over the last 3 years, we've averaged about 7,500 homes at the end of for the year, the entire year that come onto the market. And people just are not putting their homes on the market. And you can see here we were actually down 5.6% for the year. The reason inventory is increasing, as we stated a little bit earlier, is because buyers are simply sitting on the sidelines or they're going somewhere else. And you can see here this is indicated by closed sales. So our closed sales for the year right now ended at 4,289. That was down 13.7%. So 13.7% fewer buyers bought in our market than in the year 2022. And again, if we can put it on a historical time graph here, you can see that closed sales, people buying homes, has always gone up since the Great Recession. Took a little bit of a steadiness here, and then you saw the pandemic it went down, so people were not buying during the pandemic. And then as soon as we opened up here in 2020, our sales just went straight up. And they went straight up until when? June of 2021, when I told you that the median price home went above $500,000. And since then, since that price point of $500,000 went, the sales have gone down. Right here, the Fed increased interest rates, and since then, just down, down, down. So, since 2021, we have seen a total of 42.64% drop in closed sales for our market. So, in closing on the year 2023, you have inventory increasing, you have sales decreasing, and you have, for the first time, home prices decrease by 3.7%. 2023 was significant in the sense that we've actually saw a move towards affordability. Now, 3.7% year-over-year loss is not a market crash. In fact, if you were waiting at the end of 2022 for a market crash, at the end of 2023, you're still disappointed. It hasn't crashed. And if you're still in that boat, I'm going to suggest that you should expect 2024 to be like 2023. And 2023 was characterized by high prices and high interest rates. And I expect 2024 to be the same. Let's talk about affordability. What would cause affordability in 2024? I know there's a lot of possibilities out there. We're talking about likelihoods. What is possible is any number of black swans could crap on the housing market. We could have war. We could have a commercial real estate collapse that collapses banks, that collapses businesses, that causes a lot of unemployment. To have a housing crash, you got to have houses, and we're short on inventory right now. If there's clay feet to the market, it would be unemployment, but understand that that unemployment would force the sellers here not to give their houses back to the bank like they did in 2008. It may force them just to put their houses back on the market and hope to capture some of the equity that they have in it. And it's at this point I want to distinguish today's seller with the seller of 2008, because this is where we are different, and I make this claim boldly. This market is different than 2008 because of the seller. The seller today has 70% of all mortgages out there right now are under 4%. And those mortgages were bought or refinanced prior to March of 2022. So based on their price and their mortgage rate of being 4% or under, their monthly mortgage payments are less right now than if they were to go out and rent. And I know you've heard, especially from the Wall Street Journal, that in today's market it's cheaper to rent than buy. And that's true based on today's prices and today's interest rates. But 70% of your mortgage holders don't have today's prices at today's interest rates. They have interest rates under 4% with purchases purchased before 2022, and their monthly mortgage rate is cheaper than rent today. If you lose your job and you try to give your house back to the bank right now, you're going to jump into a more expensive rental market, and you're going to give up, on average, $200,000 equity in your home. Today's seller is much stronger than the seller in 2008. They were able to purchase houses with little to no down payment. They were able to purchase houses with interest-only monthly payments, variable interest rates. They got in with very little skin in the game, and because of those variable rates, they saw their monthly mortgage payments going up and up and up. Now, if you're sitting on a house with no skin in the game, you haven't put any equity into it, and in fact it's losing value, and your monthly payment is going up, you look at the rental market and you see, man, I can go rent a house right now and just give my keys back to the bank, and I can have a cheaper monthly existence because it's cheaper to rent than hold on to this mortgage that keeps going up on me. So in 2008, people were incentivized. Sellers were incentivized to give their houses back to the bank. That is totally different than today's seller. So please understand, if you're waiting for a sudden rush of homes to come on the market, even with unemployment, it's not likely. And it's not likely because you have different sellers than you did back then. Okay, how about interest rates? Is that going to save our market over the next 12 months? I don't think so. And the reason I don't think so is the Fed has set a target rate for inflation at 2%. We're sitting at 3.7% at the beginning of 2024. What's going to cause inflation to go down another almost 2% over the next 12 months? Do you guys see the price of your gas and the price of your cheese and the price of your insurances going up or down over the next 12 months? I argue that these next, about 2% inflationary points that the Fed's aiming for are going to be the hardest. It's kind of like dieting. The first 10 pounds are easier to lose than the last 5. And I think that's the environment that the Fed finds themselves in now. And if they truly hold to their word and they want to get down to 2% inflation, it's going to take time to get there. And they have several opportunities this year to reduce rates, but the only way they're going to reduce rates is if they start to see that inflation come back down towards that 2% rate. I don't think it's likely that we're going to see interest rates go below 6%. So over the next 12 months, if you're making your plans and you're hoping for the interest rates to make things more affordable, I don't think it's likely. Expect between 6 and 7% mortgage rates. If we go below 6% and we get into anything with a 5 in front of it as far as mortgage rates, that will increase affordability, which will then bring people back into the market. And understand, our market is characterized by people sitting on the sideline, both buyers who are waiting for prices to come down, and sellers who are waiting for prices to come down, because 75% of your sellers are then buyers. And they can't become buyers if they sell their house and they go out and buy something at twice the interest rate that they have now at prices higher than they have now. So interest rates really need to come down under 6% to bring people back into the market. And it's kind of like this, as rates go down, it brings more people back into the market. Well, that flattens itself out. That affordability brings more people into the market, and it stabilizes prices. If you get more people wanting to buy than homes are on the market, that could increase prices, and that's what we've seen over the last several years. In order for those prices to come down, that would mean that these buyers would have to wait, and there would have to be sellers that are selling their homes at a higher rate than buyers would buy them up. And I don't see that as our environment right now. I think if you're going to envision the housing market as a whole in the country, envision it as a Costco parking lot. There are a limited number of parking spaces. There's a limited number of homes. And there's a lot of people sitting on the sideline waiting for something they can afford. As soon as somebody backs out of that parking stall, in a Costco parking lot, you've usually got people competing for that stall. And that's how I see our market right now. There's a lot of people sitting in the aisles of the parking lot with their blinkers on. They're just waiting for something that they can afford. And as soon as they see something they can afford, they're going to engage. And there's going to be more people than they think for competition. And that's my advice to those of you that are sitting on the sideline right now. Understand, if you're in the waiting game, you're not alone. And that competition, as soon as affordability comes back, is going to be intense. So realistically, what we're telling our clients is, if you can afford a house, it's wise to buy. And again, the caveat there is if you can afford it. You do not want to become house poor, and you don't want to try to beat the market. A lot of people are trying to beat the market right now, thinking that they can build a house or put a tiny house on property. You guys, you need to call me and we can talk through this. That is not a way to beat the market. When Bonnie and I bought, when we were first married back in 1989, we wanted a 3-bedroom, 2-bath house with a nice backyard. We couldn't afford that, so we ended up buying a 2-bedroom, 1-bath condo that shared a washer and dryer between 4 units and shared a garage with another unit. We didn't desire that, but it got us in the market. And from there, we were able to do what the market did. As the market went up, the price of our condo went up, and we were in the market. If you can afford a house and you can afford to get into it, and you are not looking to sell it in the next 2 to 3 years, I think you need to buy. If you're looking to flip or speculate a house, you're not going to make the equity over the next 2 or 3 years to cover your expenses. However, if you're moving here to retire or raise a family and you want to be in a really good community, we can help you figure that out. Just give us a call. The link is in the description below. All right, until next time, take care. Bye now.